Hey everyone, we will go ahead and get started. Again, my name is Jim Davis, and thank you for taking the time to jump on today. We're going to be joining us. Ella Radberg, my colleague, is going to be joining us today. You can see her in the background. She'll be monitoring, letting people in and out, and fielding all your questions and answers, the chat, and things of that nature. So like we said, today's webinar is on tax-efficient charitable giving strategies. Like I said, I'm Jim Davis. I'm one of the partners and senior wealth advisors at Aspen Wealth Management, and I'm thrilled to have you join us. As many of you know, here at Aspen, we're passionate about helping you guys achieve your financial goals. It's part of what we do with comprehensive planning. But what's really important is that we do so in a way that aligns with your values. And so today we're going to dive into the intersection of philanthropy and financial planning, specifically how you can support the organizations you care about while also being as tax efficient as possible. This topic is particularly timely as we approach the holiday season, a time when many of us are reflecting on how we can give back. But did you know that the way you give can significantly impact your overall financial picture? And that's really what we're going to talk about today. We're going to go over strategies like qualified charitable distributions, donor advised funds. Some of y'all have heard of us refer to them as DAFs, and the benefits of donating appreciated stocks. Along the way, we're going to share some practical examples as well of how these strategies work in real life. Everything we talk about today, we've executed hundreds of times for our clients. And I just realized on my screen, you might see a little Ring Central alert. So we'll go over here. But before we kind of dive into it, I want to start at a high level. Like, why does charitable giving matter? Okay. For many of you on this call today or watching this recording online, supporting causes that resonate with you is a deeply personal endeavor. Maybe it's your church, a local food bank, or an organization that's made an impact on your family. Whatever the cause, giving allows us to connect with our community and leave a meaningful legacy behind. But charitable giving isn't just about writing checks. It's about creating a deeper connection between your personal values and your resources. Think about it. When we give, we're not just transferring money or moving an asset to another organization. We're making a statement about what we care about. It's an opportunity to express what matters most to us, whether it's supporting education, healthcare, the environment, or any other cause that speaks to your hearts. And here's where it gets even more interesting. Charitable giving can be a strategic element of your overall financial plan. You see, when approached thoughtfully, charitable donations can not only help the causes you believe in, but also offer significant financial benefits. Let's take an example. Let's say you're donating to a charity. And many of you know, obviously it's a deductible expense, and so you can reduce your taxable income. But what if you had a particular year where you have really high income? Maybe stock options have vested, or a bonus has come through, or you've sold a piece of property or a business. These things can result in substantial tax savings, which means more of your resources can be allocated to causes that truly matter. It's kind of like getting a 2-for-1 benefit, making a positive impact while enhancing your financial position. But the beauty of strategic philanthropy goes beyond just tax planning. Again, it's about aligning your financial decisions with your personal values in a way that's both intentional and impactful. Whether it's setting up a charitable trust or contributing to a DAF or using appreciated assets like stocks for your donations, there's many ways to maximize your gift of giving. At Aspen Wealth Management, our goal is pretty simple. It's to help you give in a way that maximizes both the impact of your donations and your financial efficiency. We're going to walk through the options and strategies that will help you achieve your charitable giving objectives. And whether you're giving now or maybe planning for down the future, we want to ensure that your generosity creates the biggest impact possible, both for the causes you care about and your financial well-being. And so that brings us to the heart of today's discussion, tax-efficient giving strategies. Okay. One thing we want to talk about with tax efficient strategies also is maximizing your donations and financial efficiency. Okay, so like we mentioned earlier, whether you're giving to a local organization or you're contributing to a fund, we want to make sure you're walking through all the different options and strategies that's going to help you achieve your objectives. And so let me see here. I apologize for the delay. So different ways we're going to give. Tax efficiency is what transforms your charitable giving from a generous act into a financial strategy. And trust me, this isn't just a technical exercise. It's about making sure your hard-earned money has the greatest possible impact. When we think about charitable giving, it's easy to view it simply as an act of kindness, and it is. But with the right strategies, it can also be a smart move that works for both your financial and philanthropic goals. So let's start with a common misconception. Many people assume that cash donations are the best way to give. And while that's certainly one option, it's often not the most tax efficient. Cash donations offer an immediate way to support a cause, but there's a better way that many don't consider. Like, as you see on the screen here, donating appreciated securities like stocks or mutual funds. These can allow you to avoid capital gains taxes on the appreciated position while still receiving a charitable deduction for the full market value of the asset. Imagine this. Imagine you bought Apple or Amazon or any stock a long time ago that's grown substantially. So you've had a stock for years and it's appreciated quite a bit. By donating that stock directly to a charity, you avoid the capital gains tax that you'd pay if you sold it, and you still get a charitable deduction for the full value of the stock. This is a great and common way to make a larger donation without feeling a tax hit. And the timing also extends to retirees. So let's say you're in the retirement phase of your life and you're drawing from your retirement accounts. There's another tool at your disposal that you see on the screen here called a Qualified Charitable Distribution. Sometimes we refer to these as QCDs. For those of you who are 70 and a half or older, QCDs allows you to direct up to $100,000 per year per person from your IRA directly to a charity. And that distribution, it counts towards your RMD, right? So let's say we're over 72 or 73, we're taking our required minimum distributions. The amount you send out of your IRA to the church or charity of your choosing, it counts towards your RMD, but it's a really powerful tool because it doesn't increase your taxable income. So let's just hypothetically say you had a $50,000 RMD and you didn't want to take 50,000 of income. You didn't need it. You've got other income sources, maybe a pension or Social Security. Well, you could take a certain amount of that, let's say 25,000 of the 50, and donate it to a church or charity directly from your IRA to that 501c3. You will have satisfied taking out the $50,000, but you're only going to pay taxes on 25,000 or half the amount. So yes, it's a very powerful tool. It not only satisfies RMDs, but also reduces your taxable income, and it can help you maintain a more favorable bracket. We're going to talk about those quite a bit more later in this presentation. But here's the thing. These strategies, I want to be very clear here, these strategies are not one size fits all. They are most effective when tailored to your specific financial situation and integrated into a comprehensive financial plan. That's where we come in. At Aspen, our goal is to help you understand your full range of giving options and create a plan that aligns with both your financial and philanthropic goals. We believe in looking at your entire financial picture, from your income to your assets to your future retirement needs, so we can develop a strategy that optimizes both your tax efficiency and the impact of your charitable contributions. Okay, so now let's move on to some specific strategies that we can help implement and explore how we can build these strategies in your financial in your greatest impact. As you see on the screen here, we've got various designations like beneficiary designations, donating appreciated stocks, bunching donations we're going to talk about later. And the reason I put them in this order is I think it ranges from the most simplistic to the more complex. So cash and changing beneficiaries, I mean, that takes little to no effort. Donating appreciating securities is a little more technical, but very easy to do. Bunching donations is something we'll talk about later. Again, it's really kind of lumping charitable donations into every so many years. Donor advised funds and QCDs, or DAFs and QCDs, we're going to talk about. And we're not going to hit on trust and other estate planning tools too much today, or private foundations. There are certainly tools and resources you can use to minimize your estate taxes, but the purpose of this presentation is really going to camp out on the first 5 things we're looking at today. So let's get into tax benefits of charitable giving. Okay. Charitable donations do more than just support meaningful causes. They can also create significant tax advantages. When you itemize your deductions, charitable contributions can reduce your taxable income, which is really beneficial if you're in a higher income bracket. And this means that every dollar you give to a qualified organization not only helps the cause, but also reduces the amount of income the IRS is going to tax you on. Okay, so kind of as you see on the screen here, it's not uncommon for us to find folks who are in their prime earning years. They're in their 50s or 60s, and they've made substantial income. But like many of you on this call, you want to retire, right? And so you're in your prime earning years. You've identified that you want to retire, but you've also identified that one of your goals in retirement is continue tithing to your local church or giving to a local charity. Okay. And so as you see here on the screen, in this illustration, we've got a person who's retiring at the age of 65. Their income falls off a cliff, right? And their marginal bracket, as you see here, drops substantially. And so the question begets, like, do you want to get a tax deduction in your prime earning years when you're at a 35 or more marginal tax rate? Or do you want to get a tax deduction when you're at a 10% tax rate or 12% tax rate? And that's where strategy comes into play. What some folks would do in this scenario is they would kind of pre-fund their retirement in their high earning years using some strategies we'll talk about here in a minute. They will use that money they've set aside in certain accounts to tithe out of. And then down the road, when those RMDs kick into gear, we can use other strategies like qualified charitable distributions. I don't want to get too far ahead of myself, but as you can see here, there's a lot of strategy that can be involved. And at the end of the day, we're still giving the same amount to church and charity that we were intending to before. We're just doing so more tax efficiently. Okay. Let's take it a step further. Charitable giving can also help minimize your exposure to additional taxes, like the net investment income tax. For those of you who are on the top tier of tax brackets, this is an additional 3.8 surtax, 3.8% surtax on investment income, and it can be an unwelcome expense. So strategic charitable giving can potentially reduce your modified adjusted gross income and help you avoid or at least lessen the impact of that tax, right? Let me share a practical example of how powerful this can be. So imagine you're in a year where a significant bonus, the sale of an asset, or maybe another windfall pushes you from one tax bracket into a higher tax bracket. That extra income might be taxed at a significantly higher rate. A well-timed charitable donation, whether it's cash, appreciated securities, or even a gift from your IRA, can potentially bring your taxable income back into a lower bracket. This not only reduces the taxes you pay, but makes an impact on the donations you've made, right? It makes me more valuable. And it's not just federal taxes where you can find savings. Many states, some of you, a lot of y'all on this call are in Texas. As I say, y'all, a lot of y'all are from Texas, but I know we got several clients across the country. So it's not just federal taxes where you can find savings. Many states offer their own tax incentives for charitable giving, which can add to even more savings. And depending on your state, you might qualify for additional deductions or credits for donations to certain types of organizations, like local nonprofits or maybe educational institutions. Okay, so now let's focus on an area where charitable giving can be particularly powerful. We're going to look on the screen here at that orange section. Again, so this is a person who is retired. Their income was in the blue. It fell off a cliff because they're now in Mexico and enjoying themselves and having fun. But down the road, we know we're going to have to pay RMDs on the money that we've been saving in tax deferred accounts like 401ks and IRAs. Okay. So when this time comes, when you reach RMD age, typically 73, 72, 73 for most folks nowadays, the distributions from your traditional IRA become taxable income. For many, these distributions not only increase their tax liability, but can also push them into higher modified adjusted gross income thresholds, triggering a term you guys have heard on another webinar we've done, triggering surcharges like the income-related monthly adjustment amount. I'm going to say that again. If you push your income too high and you're over the age of 65, you're going to be charged a surcharge on Medicare called the income-related monthly adjustment amount, otherwise known as IRMA, on your Medicare premiums. This is where qualified charitable distributions come into play. A QCD can allow you to transfer up to $100,000 per year directly from your IRA to a qualified charity. Again, we've talked about this a little bit before. And by doing this, the distribution counts towards your RMD, but is excluded from your taxable income. And this can help you avoid exceeding IRMA thresholds and reduce your overall Medicare premiums in the following years. So for example, imagine your RMD put you just over the IRMA threshold for the year. Instead of withdrawing the full amount and paying taxes on it, You could direct a portion of your RMD to a charity via a Qualified Charitable Distribution or a QCD. Not only does it satisfy your RMD, but also keeps your adjusted gross income lower, helping you avoid some costly Medicare surcharges. Because if the less we pay in fees, the less we pay in taxes, the happier we all feel. But to belabor the point, here's the key to all this. These strategies work best when they're thoughtfully integrated into a broader financial plan. Okay? They are one slice of a big old pie, and that pie is taxes, it's estate planning, it's retirement, strategic retirement income planning, it's investment management, it's insurance analysis. A financial plan ordinarily involves several components. Charitable giving is one piece of them, but as you can see here in this presentation today, it's very intertwined with things like investment management, retirement income planning, and tax planning. Okay? So again, it's not just about writing a check. It's about understanding how your giving fits into your overall financial plan. For instance, are you optimizing your gifts through donor-advised funds or QCDs? Have you considered the tax implications of gifting highly appreciated assets versus cash? These nuances, they can actually make a huge difference in both the impact you're giving and the tax benefits you receive. And this is why we emphasize charitable giving as a critical piece of strategic financial planning here at Aspen. By aligning your giving with your financial goals, you can support the causes you're passionate about while ensuring your wealth works as efficiently as possible. So as we move forward today in this presentation, we got a lot left. I encourage you to think about your own giving strategy. How can it serve not only the organizations and causes you care about, but also your broader financial goals? And with the right planning, you can achieve both in a way that's deeply impactful and incredibly rewarding. Okay, so now what we're going to do is we're going to go through a few very common strategies that a lot of folks, at least clients of ours at Aspen, have executed as their financial goals to us have been, we want to continue tithing to our local church or supporting maybe where we are alumni at from a college, or we want to give to Cook Children's in Fort Worth, things of that nature. These are very common techniques, so we're going to cover 3 or 4 of them. And then we'll talk at the end of some practical examples. So the first strategy you can consider for charitable giving is donating appreciated securities. Okay. If you hold highly appreciated stocks, donating it directly to a charity can be one of the most efficient ways to give. And here's why. When you sell appreciated stocks, you incur capital gains. You buy a stock for 100, you sell it for 200, Uncle Sam wants a cut of the difference. But by donating those securities directly, you avoid the tax entirely while still receiving a deduction for the full fair market value of the asset. And this strategy can also help you rebalance your portfolio. For example, several of our clients maybe have had stock options or concentrated stock positions, whether they wanted to or not. They're an employee of a company and maybe that's part of their compensation package. So over time, you work there long enough, a large part of their portfolio gets concentrated in a single stock. Well, by donating a portion of it, you can reduce your risk exposure by having too many, all your eggs in one basket, if you will. You can avoid capital gains and support a cause that's close to your heart. It's a win on all fronts. Okay. Let's take an example looking at the screen here. On the screen, you see someone who bought a stock when it was worth 20 grand. Stock has gone up. It's now worth 50 grand. Person on the left, and this is what we see when we do a financial plan, we'll see their tax returns and go, okay, so you incurred a capital gain and you tithed. That shows up on a tax return pretty easily. So what do we do there? Well, we bought a stock for 20,000, we sold it for 50,000. We're going to pay $7,140, assuming you're in a higher tax bracket, which is 23.8%. Okay, that could be a short-term capital gain or a long-term capital gain if you're in a high enough bracket. This would be a long-term capital gain with that net investment income tax on top. So the total contribution to charity after deducting federal taxes, $42,860. So the income tax savings by making that contribution, by selling the stock, paying the capital gains, donating the proceeds, 15 grand and some change. Okay. Person on the right buys a stock for 20,000, lets it grow to 50,000, doesn't sell it, gifts those shares directly to a 501c3 and immediately receives an $18,500 deduction, which is the greater amount. Okay, so if you find yourself in a position where you want to tithe or give to a local organization and you have appreciated non-retirement assets, this is one incredibly popular tool to use that's very effective. Don't sell the stock and pay the gain. Donate the stock, get the higher deduction, and it avoids you just paying more taxes than necessary, right? Beyond rebalancing, this approach is especially valuable during high income years. If you've recently sold other assets, like exercising stock options, or you've received a large bonus, the charitable deduction can help offset the increased income. By pairing the donation of appreciated stock with other tax strategies, you can significantly reduce your taxable income while amplifying the impact of your gift, right? Just looking at the screen here, I mean, just think, not only did the guy on the left pay more in taxes, but he donated less to charity, right? It's a win on all fronts if you play this card with a highly appreciated stock in a brokerage account, because you give more to charity and you get more in taxes deducted anyways. Lastly, the last benefit of this one that I think is really true is flexibility. You don't have to give the entire stock position in one go. For instance, some of our clients use donor advised funds. We'll talk about those in the next slide. These allow you to claim to tax deduction immediately while giving you some time and some breathing room to give to charities down the road. Okay. Um, so donating appreciated securities, again, at a high level, if you have non-retirement assets that are highly appreciated, instead of selling those, incurring capital gains, and donating the proceeds, you're giving the stock directly to a charity or a 501c3. Okay. So then the next question, the next slide, donor advised funds, a very popular tool. Because some people get here with donating appreciated stocks and they say, well, Jim, I don't know if my church can just take stocks, or I don't know if this small nonprofit can accept stocks. They don't have the operations in place to be able to receive my shares of, one security. That's perfectly fine. You can also use a donor advised fund. A donor advised fund, also known as a DAF, is an incredibly versatile tool for charitable giving, and one that, frankly, we're a fan of at Aspen because it's such a flexible tool that allows you to do so many different things with your charitable donations. One of the most practical applications we see is clients front loading a DAF with several years worth of donations during high income years. For example, like we said in the slide 2 slides ago, if you're planning on retiring, so let's say you're retiring at 65 and you know that at the age of 60, you've got 5 years effectively to start socking away donations into a donor advised fund while you're still earning a high salary. This creates a significant tax deduction while establishing a fund you can use to support your causes during retirement. But the benefits don't stop there. DAFs also allow your contributions to grow tax-free. Once you've contributed money into a DAF, the funds can be invested, potentially increasing the amount you have available to give over time. This means your generosity can have an even greater impact on the causes you care about. Okay? Flexibility is another key advantage of DAFs. Instead of scrambling to decide where to donate before year end, you can make your contribution to a DAF now and take your time deciding where the funds will go. It's kind of like creating your own charitable foundation without the administrative burden and costs. Okay, so if you look here on the screen, what happens is a donor, let's say John Doe, he decides, hey, I want to retire at 65. I know between the age of 65 and let's say his RMD age is 73. Okay, we got an 8-year runway of years until he retires and to when the next slide comes up on qualified charitable distributions go into effect. But he also knows one of his goals, as he's told our team, is that he wants to keep tithing 10 grand a year to his church in perpetuity. Okay, so what do we use a DAF for? Well, what we could do theoretically is in 1 year or broken up into several different years. We'll talk about lumping donations here in a little bit. He could put $80,000 into a donor advised fund during his prime earning years or her prime earning years, immediately receive a tax deduction the second those shares or the money hits. Okay, so he'll get the tax deduction the second he donates it. It's a completed gift at that point. And that money can sit there and just grow or be invested. And then when he fully retires, he can then start distributing $10,000 a year from his donor advised fund account to the charities of his choosing. Okay, so you receive the income deduction now, and you can grant funds to charities later. Now, I want to be very clear here. With a donor advised fund, the second you put any asset or money into these things, it is a completed gift. Okay, that money is never coming back to you. It's not going to your kids. It will leave that donor advised fund and it will go to a 501c3. Okay, that's very important. Some people say, well, is it gone forever? It's technically not gone forever. It's just you're never going to get it back. It's going to go to a church or a charity of your choosing somewhere down the road. Okay. Let's give an example of clients who use DAFs to plan their giving well into the future. Okay. One of my clients personally in the last year funded their DAF in a year when they sold a business. They took advantage of a large deduction to offset the sales tax impact. And over the next decade from their donor advised fund, that's what they're going to make annual donations out of to their favorite local nonprofits. Lastly, DAFs make it very easy to engage your family in philanthropy. I love this one because it pulls on tax planning, charitable planning, or philanthropic planning, investment management, but also estate planning. Families who use donor advised funds can also use them as a tool to teach younger generations about giving by involving their children or their grandchildren in choosing which charities to support. This turns your charitable efforts into a shared, meaningful experience that can extend across generations. I encouraged a client a year or so ago when they set up a donor advised fund, and they knew they wanted to give a good portion of it to their local church, but they also wanted their kids to start thinking philanthropically. So they told their kids, hey guys, every year I want you to each come up with a charity. So the 3 kids, so 3 charities, and every year we're going to cut a check and donate to the charities of your choosing. But I wanted to be thoughtful. It could be your local church as well, or 501c3 or nonprofit. And so it was a really great way to kind of incorporate philanthropy with estate planning and tax planning all in one. So we've talked about this next slide quite a bit. We've touched on it. We've kind of gone over it with that graph with the person who was making a lot of money and they retired. Qualified charitable distributions. These are also one of the most powerful tools for retirees to give back. We often meet retirees who take their required minimum distributions. And like we said, it's so easy to see it on a tax return. They have on their tax return, you'll see they have ordinary income from a retirement account. But then you scroll down the tax return, you go, oh, you got a large charitable donation, to a church or charity. And so you kind of look at those together and go, okay, did we mean to take that much money out of the IRA? And maybe they did, right? But oftentimes when we meet with prospective clients, they take their required minimum distributions, they deposit them in their bank accounts, and then from that bank account, they write a check to their church or favorite charity. And while this is generous, there's no knocking that strategy, it's not tax efficient. That RMD increases your taxable income, which, as we said, could lead to higher Medicare premiums or even taxes on Social Security. With a QCD, you can bypass that entirely. You direct your RMD directly to a qualified charity. You reduce your taxable income while you still meet your RMD requirement. And this isn't just a one-time strategy. It's something you can incorporate annually to keep your income lower over the long term. And for those of you who give regularly to your church or other organizations, it's a seamless way to integrate philanthropy into your financial plan. So operationally, how does this look? Well, you got an IRA, let's just say you're 75 years of age. The IRS is going to look at the IRA as of the value of December 31st, the prior year. So as of today, if you haven't made your RMDs already, I'd encourage you to start looking into it because we're running up on the end of the year. But let's say on November 20th, 2024, you needed to take an RMD or you wanted to take your RMD. That amount, your RMD amount, is going to be predicated based on the December 31st value of your IRA, your pre-tax assets as of the prior year. Okay. And so from that IRA account, it could be, and if you have IRAs spread out in different institutions, it's the total aggregate of your IRAs, and there's different rules for 401ks and other accounts, so we can talk about that another time. But at large, you take from your IRA, and whoever your custodian is, you give them a call, or you give your team at Aspen Wealth Management a call, say, hey, I'd like to make a donation to, my church or this charity directly from my IRA, because you need to make sure it's coded properly. That check will go from your IRA to that 501c3, or maybe it goes to you and it's your job to hand it to them. It is not your check to cash. It's a direct contribution or donation to a local charity. The last strategy we're going to talk about is bunching charitable donations. Okay. Bunching charitable donations, it's a strategy, it's a technique that you can actually execute using all three of these, right? Bunching charitable donations is essentially putting any of the strategies we've talked about, donating stocks, DAFs, QCDs. It's bunching them together. It's more so DAFs and appreciated stocks. The QCD it doesn't apply to this one as much, but we'll talk about that. Bunching donations is another smart strategy for maximizing tax benefits. Instead of making smaller donations each year that fall below the standard deduction threshold, you can bundle several years' worth into one large contribution. This pushes you above the standard deduction, allowing you to claim a significant charitable deduction while planning your giving for years to come. Okay, so it pushes you from standard to itemized, right? And so you can see on the screen here, this person on the left they're donating $5,000 a year to their church or charity of their choosing. Okay, but because of their state and property taxes, their mortgage interest, their charitable gifts, they're always going to be with this donation amount below the standard deduction line. Okay, as you can see kind of clearly on the screen. But by bunching your gifts, you can say, hey, rather than give $5,000 a year, what if I put $15,000 into a donor advised fund, right? Or if I put, $15,000 worth of highly appreciated stock into a donor advised fund, okay, in lump sum, and from that donor advised fund, I still distributed $5,000 a year in subsequent years. Now, when you distribute from a donor advised fund, you don't get the tax deduction on the money out. You only get it on the money in. So you put $15,000 in, and as you can see here on the screen, this is going to save this person, roughly $7,000 in tax savings by doing this, or tax deductions. Apologize. So instead of making smaller donations below the standard deduction, you can bundle several years into one large contribution. This strategy works particularly well in high-income years. For instance, if you've sold a business, if you've exercised some stocks, you've received a large bonus, bunching donations can offset some of the additional income while reducing your overall tax liability. Pairing this with other strategies, like funding a DAF during a high-income year, can create even greater tax savings. By contributing to a DAF, you secure the deduction now and have the flexibility to distribute the funds to your chosen charities over time. This approach not only simplifies your giving, but also ensures your contributions align with your long-term philanthropic goals. Lastly, this strategy allows you to take advantage of market conditions. If you have a highly appreciated asset, bunching donations can be combined with gifting those securities directly. This avoids capital gains taxes, amplifies the impact of your donation. For example, one of our clients recently used this method to streamline her giving while reducing her exposure to a large tax bill during a high income year where she had to exercise a large chunk of stock. And so this is a great way to exercise that stock, diversify that position, right? But also donate to charity. And that's going to be essentially her quasi-tithing account for the years to come. By strategically planning the timing and structure of your charitable contributions, bunching donations ensures you maximize your tax benefits and make the greatest impact on the causes that matter most to you. So in the next two slides, what we're going to go over are strategies in action. These are two different strategies. These are very practical strategies that I think you could kind of resonate with and see yourself, or maybe someone you love, someone, I could see us doing that, or I could see the value in that. And the first is going to be gifting shares, and the second is going to be using QCDs. But these are two strategies in action, real world application of how these could play out for individuals today. So in the hypothetical example below, we're showing the advantages of donating a long-term appreciated security as opposed to selling it and donating the proceeds. Okay. This individual, as you see here, is in the highest marginal tax bracket. Okay. Value of a stock is $30,000. Unrealized gains of $50,000 is the stock is worth today. They bought it at $20,000. They're going to be subject to a 23.8% Medicare surtax. Okay, a 23.8% capital gain, 20 for the capital gains, 3.8% for the surtax. With this example, you can kind of see here clearly the value of donating securities directly versus the cash direct, selling the stock, realizing the capital gain, and donating the proceeds. So as we see here, the stock is sold at 50,000 on the left. Okay. They paid taxes 23.8% on their profits of 30,000, which result in a $7,000 tax bill. This is very similar to the slide we looked at a little while ago, but it's just a different illustration that illustrates the same point. So the net amount you can donate to charity by executing this play is $42,860. Okay, which is great. I mean, if you're in the 37% bracket, that's still a huge amount to charity. Good on you. It's going to net in $15,000 in tax savings and some change. But by donating the $50,000 directly, you bypass the capital gains, you bypass the Medicare surtax, and $50,000 goes straight out the door to a 501c3 of your choosing. You not only receive $18,500 in tax savings, right? But you donated over $7,000 more to charity with the donated security. Okay. And this is a great strategy you could execute. And again, you don't have to donate the securities directly to a 501c3. You could execute the same play by donating into a donor advised fund. Now, we didn't talk about this a little while ago, but a donor advised fund, the second you put it in there, it's a completed gift. A donor advised fund at like Schwab Charitable or Fidelity Charitable or other donor advised fund companies, they are a 501c3 in of themselves. So when you donate, you're donating to a charitable, to a nonprofit organization. They're simply allowing you to kind of hold that money, invest that money, and disperse that money at your choosing. The next strategy, this is a very practical way of using a QCD. Okay. So in scenario 1 versus 2 versus 3, Phil's annual RMD is 15,000. Okay. He's going to take a portion of his annual RMD as a QCD. Okay. So he makes a $10,000 qualified charitable distribution. Okay. The remaining 5,000 will count towards his taxable income. In scenario 2, he takes his entire annual RMD as a QCD. So $15,000 RMD, $15,000 QCD. He has satisfied his full RMD requirement. His taxable amount, though, on the RMD is $0 rather than $15,000. He's pulled money out of a pre-tax account, an account that he got a tax deduction on several years ago. It's grown. He's retired now. He wants to enjoy his money. He has chosen to essentially put that RMD straight into a 501c3, and by doing so, he's effectively received $0 in taxable income from that transaction. Lastly, scenario 3, he takes his entire RMD as a QCD and donates an additional amount. Again, we've talked about you can donate in a QCD up to $100,000. So his RMD is $15,000. He makes a $15,000 qualified charitable distribution. He also makes an additional $5,000 qualified charitable distribution. He's still going to pay $0 on the $15,000, but by making additional donations through the form of QCDs, he's reducing his IRA balance, which, as y'all know, you reduce the IRA balance. Remember, it's based on the 1231 value. So he's reducing his IRA balance, which could potentially reduce future RMD amounts as well. To be clear, like you see here, none of the additional amount as a QCD counts towards future RMDs. Once you've satisfied your RMD, it's been satisfied. So going above and beyond is only good for charity. It doesn't, help you with any more taxable distributions. So going full circle, I'm going to go over this slide again. We've got lots of ways we help clients give charitably. Okay, whether it's cash, whether it's changing the beneficiary designations on their accounts to, donor advised fund or nonprofit organizations. You can donate appreciated securities. You can bunch donations together in a high earning year or a high income year, or you can use donor advised funds or DAFs or QCDs. All of these are incredible techniques that you can use and execute. We've seen them firsthand countless times here at Aspen. And we love it because nothing makes us happier than allowing our clients to achieve their goals. And if one of their goals is to give to their local church or a charity or 501c3, we want to help them do that. But we want to help them do that as tax efficiently as possible, right? And so if we can mitigate your taxes of your lifetime and still give more to charity, that's a win-win. Okay. So that covers this presentation today on essentially charitable planning and retirement. I'm now going to end the slideshow or stop sharing and open it up to questions if any of you guys have any. Nothing in the chat or the Q&A. Perfect. Well, I hope this was helpful for you guys. If y'all do have any questions at all, please do not hesitate to give us a call. Our email is on the screen. You can look on our website and find our direct numbers there as well. Again, my name is Jim Davis and my colleague Ella is on the call today. We thank you all for being here and for joining us. And this will be available as a recording after the fact if you ever want to watch it again or take notes of something or send it to a friend or family member. Thank you guys so much and I hope you have a great day.